Here's something most families never find out until it's too late. When wealth passes through a simple will and nothing else, a meaningful piece of everything you built can get carved away. Probate costs, legal fees, court delays, and for larger estates, a federal estate tax that tops out at 40% on every dollar above the exemption. Think about that. You spend 40 years building something, and in the worst case scenario, the transfer itself becomes the single most expensive financial event of your family's life. And here's the part that bothers me most. It's not the money, it's what the money was supposed to do. When an inheritance gets fragmented, delayed, and taxed, you don't just lose dollars, you lose the ability to shape what your family becomes with them. Most people don't have an estate plan, they have an accident waiting to be probated. Today, we're going to fix that. Stop settling for an accidental inheritance and start building an intentional one. I'm Reza Zamani, founding partner at Steel Peak Wealth, and I want to challenge something you've been told your whole life. You've been told to save. Max the 401k, build the emergency fund, chase the best high-yield savings rate. And look, that's all fine. That's the price of admission. But savings accounts don't build dynasties. Structure does. While most people are comparing interest rates, families who successfully move wealth across generations are asking a completely different question. Not, how do I grow this, but how does this transfer? They use irrevocable trusts, strategic gifting, and deliberate legal architecture to move assets outside the reach of estate taxes, probate courts, and creditors, often decades before anyone passes away. That's the difference between leaving money behind and building a legacy. One is an event, the other is a system. So today, I'm breaking down the actual mechanics, the same categories of tools sophisticated families use in plain English. By the end of this video, you'll understand the three layers of legacy planning: the foundation, the structures, and the operating system. Quick but important note before we dive in, I'm going to talk about tax law and legal structures. This video is education, not personalized advice. Everything here depends on your situation, and you should work with a qualified estate attorney and tax professional before implementing any of it. All right, let's go. Let's start with the uncomfortable truth about wills. A will is not a wealth transfer strategy. A will is a set of instructions for a court. When you die with only a will, your estate goes through probate, a public, court-supervised process where a judge validates the document, creditors get invited to make claims, and attorneys get paid by the hour. Three problems with that. Problem one, cost. Probate fees and legal costs vary by state, but they routinely consume a percentage of the gross estate. And in states with statutory fee schedules, like right here in California, those fees are calculated on the value of assets before debts. You could owe fees on a house's full value even if it's mortgaged to the roofline. Problem two, time. Probate commonly takes a year or more. Your family doesn't get access to assets while grieving. They get a case number. Problem three, it's public. Anyone, a curious neighbor, a predatory advisor, an estranged relative, can look up exactly what you left and who got it. And there's a fourth, quieter problem. A will transfers assets, but it transfers zero wisdom. An 18-year-old who inherits a lump sum outright gets a windfall. Windfalls get spent. Studies of inherited wealth consistently show that most family fortunes don't survive past the grandchildren. Not because of taxes alone, but because the money arrived without structure, guidance, or guardrails. That's what I mean by an accidental inheritance. The government and the courts wrote your family's plan because you didn't. So, what does intentional look like? It starts with understanding the rules of the game. Here's the current landscape, and honestly, it's the most favorable environment for wealth transfer in modern history. Right now, the federal lifetime estate and gift tax exemption is sitting at a historic high, and it effectively doubles for a married couple. Congress made those elevated levels permanent in last year's tax legislation, so the sunset everyone was panicking about, off the table, at least for now. But anything above that threshold gets taxed at rates up to 40%. Separately, there's the annual gift tax exclusion. Every single year, the IRS lets you hand a set amount to as many people as you want: kids, grandkids, their spouses, without filing a gift tax return and without touching your lifetime exemption. Married, you and your spouse can each use it, doubling the impact per recipient. And here's the thing, this allowance doesn't roll over. Every year you don't use it, you're leaving money on the table, permanently. And here's one almost nobody uses. Direct payments for tuition and medical expenses are unlimited. Pay the school or the hospital directly, and it doesn't count against the annual exclusion or your lifetime exemption at all. Grandparents paying private school or college tuition directly is one of the cleanest wealth transfers that exists. Now, I know what some of you are thinking. Reza, my estate is nowhere near that threshold. Why do I care? Three reasons. First, many states impose their own estate or inheritance taxes with far, far lower thresholds. Second, exemptions are set by Congress, and Congress changes its mind. What's permanent today is one vote away from not being. Third, and this is the big one, everything else in this video, the probate avoidance, the asset protection, the control over how your kids receive money, that matters at every wealth level. The estate tax is only one of the four horsemen, layer one of legacy building. Get assets moving before you die. The math is simple but powerful. Every dollar you gift today removes not just that dollar from your future taxable estate, it removes all the growth on that dollar. Gift 100,000 in stock to your kids' trust today, and if it triples over 20 years, you've moved 300,000 of value out of your estate for the tax cost of 100,000 of exemption. Appreciation is the whole game. Practical foundation moves, systematic annual gifting, the full exclusion to every recipient every year, like clockwork. A couple with 3 married kids and 6 grandkids can move a serious amount of wealth every single year with zero paperwork and zero exemption used. Do that for a decade and you've quietly relocated a fortune, legally, tax-free. Skip a year, and that year's capacity is gone forever. That's money left on the table. 5, 2, 9 plans with super funding. Education is a legacy asset. The tax code lets you front-load 5 years' worth of annual exclusions into a 529 all at once, per beneficiary, growing tax-free for education, direct tuition and medical payments, unlimited, as I said. Write the check to the institution, not the person. And gift appreciating assets, not cash, usually. Here's the nuance most videos skip. Assets you hold until death get a step up in basis, wiping out capital gains for your heirs. Assets you gift carry your original basis with them, so the sophisticated move is gifting assets you expect to appreciate the most going forward, while sometimes holding highly appreciated assets until death. This is exactly where a real advisor earns their fee. It's a chess decision, not a checkers one. Gifting is the foundation, but gifts outright still land in someone's personal name, exposed to their divorces, their creditors, their decisions at 22. That's why the next layer exists. Layer 2, trusts. This is where intentional families separate from accidental ones. First, know the two species. A revocable living trust is the workhorse. You control it, you can change it, assets inside it avoid probate entirely, and your instructions stay private. For most families, this alone, a funded revocable trust instead of a bare will, solves the cost, delay, and privacy problems from earlier. But understand, because you still control it, it's still in your taxable estate. It's a probate tool, not a tax tool. An irrevocable trust is where the real wealth transfer happens. You give up control, genuinely, and in exchange, those assets are generally out of your taxable estate, out of probate, and shielded in ways personal ownership never can be. All future appreciation happens outside your estate. A few irrevocable structures worth knowing by name. The ILIT, the Irrevocable Life Insurance Trust. Most people don't realize life insurance death benefits, while income tax-free, count toward your taxable estate if you own the policy. An ILIT owns the policy instead, so a multi-million-dollar death benefit lands completely outside the estate. Often used specifically to create liquidity so heirs can pay estate costs without fire selling a business or real estate. Grantor trusts and greats, structures designed to freeze an asset's value in your estate today and pass the future appreciation to the next generation at little or no gift tax cost, especially powerful for business owners and concentrated stock positions before a liquidity event. Dynasty trusts. Here's the multi-generational play. A properly designed dynasty trust using the generation-skipping transfer tax exemption can hold assets for children, grandchildren, and beyond, potentially for a century or more depending on state law, without the estate tax taking a bite at each generation. That's the difference between wealth passing through your family and wealth residing in your family. And beyond taxes, trusts let you write the operating instructions, distributions at certain ages, incentives tied to education or work, protection if a beneficiary divorces or gets sued, provisions for a family member with special needs. You're not ruling from the grave, you're parenting beyond it. One honest caveat: irrevocable means irrevocable. These structures involve real trade-offs, loss of control, loss of step-up in basis in many cases, ongoing administration. They're power tools. Power tools require professionals. Now the reveal, the thing that separates families whose wealth compounds across generations from families whose wealth evaporates in one. What if your wealth wasn't a one-time payout, but a permanent engine? Because here's the truth. The documents are only half the plan. The other half is the family operating system. The families who get this right do 3 things the paperwork can't do alone. 1, they govern. Regular family meetings. The kids and grandkids know the plan exists, know the values behind it, and know their role in it. No surprises at the funeral. 2, they educate. Heirs are trained as stewards before they're ever handed capital. Financial literacy is part of the inheritance. 3, they give. Charitable structures, donor-advised funds, charitable trusts, family foundations aren't just tax deductions. They're training grounds where the next generation practices making capital decisions together, with purpose, before they inherit the whole engine. Structure protects the money. Governance protects the mission. You need both because a trust can stop a beneficiary from wasting money, but only a family culture can teach them to build with it. That's financial engineering in the truest sense. Capital plus structure plus values designed to outlast you. So here's your homework. In order. First, inventory everything. Assets, titling, beneficiary designations. Most people are shocked to learn their 401k beneficiary form overrides their will. Second, if all you have is a will, talk to an estate attorney about a revocable living trust and get it funded. An unfunded trust is an expensive paperweight. Third, start the gifting engine. Annual exclusions, 529s, direct tuition, this year, not someday. Fourth, if your net worth is climbing toward 8 figures, or you own a business or appreciating real estate, sit down with your advisor and an estate attorney about irrevocable structures while the exemption environment is this favorable. And fifth, schedule the first family meeting. The conversation is free, and it might be the most valuable transfer you ever make. Your wealth is going to tell a story after you're gone. The only question is whether you're the author. If this was valuable, subscribe and hit the bell. We go deep on strategies like this every week. I'm Reza Zamani. Build intentionally. I'll see you in the next one.